started. Good afternoon, everyone. My name is Alberto Rossi. I'm the Associate Director. I'm Associate Professor of Finance at Georgetown University. I'm the Associate Director of the Georgetown Center for Financial Markets and Policy. Welcome back to today's installment of the Georgetown Virtual Seminar Series on Fintech. Before we get started, let me remind you of our annual conference. This year, it will be virtual and will take place over the week of November 16th. In the chat, you will find the link to sign up. We have an incredible lineup of speakers, including David Rubenstein, the co-founder and co-chairman of the Carlyle Group, Barbara Novick, the vice chairman and co-founder of BlackRock, and other amazing speakers from the private sector and government. So we hope that you will sign up and attend. Let me also thank Anna Kormis, the assistant director of the center, as well as Rina Agarwal, the director of the center, and John Jacobs, the executive director of the center. Today, it is robo-advising day. I'm going to be presenting a paper, and we will have two additional papers presented by Michael Reher and Agostino Capponi. The underlying question is going to try to understand how useful are these robo-advisory technologies and how can they be improved to include novel features. So I'm going to be presenting a paper on the who benefits from robo-advising. Michael is going to be instead talking about the effect of fintech and robo-advising on the democratization of investing. And then instead, Agostino is going to be talking more about how robo-advisors can become more personalized in the future. So as a reminder, I will talk for 20 to 25 minutes interrupted. And it will be easier for me if you raised your hand towards the end and ask your questions live to me. But feel free also to write your questions in the chat. Be aware, however, that I will not be able to see your questions until the very end, when I stop sharing my screen and I can see the chats again. Okay, so let me stop my sharing and start with my presentation. Okay, let me first share my screen. A different one. Okay, can someone give me a thumbs up if you can see my screen? Okay, perfect. Thank you so much. Okay, so let me move you guys around because you're in my way. Okay, so the paper of the title of this paper is "Who Benefits from Robo-Advising? Evidence from Machine Learning," and this is a joint work with Stephen Utkus at Vanguard. And the motivation here is that we know that most of the investors out there, the individual investors, are not financially savvy. We know that financial advisors, in principle, could help, but in general, they tend to be very expensive and they are generally ineffective. So they have all sort of biases themselves, and they tend to pass their biases onto their client. And there is a very big literature here, including papers from Alessandro Privitero that is here in the audience. Now, in principle, robo-advising could be potentially very helpful because it is cheap and easy to use, and it can be deployed on millions of individuals at the same time at very low costs. And however, there is still a rather small literature trying to understand the different ways robo-advising can be done and how effective robo-advising can be. So this is an actually outdated map of the typical robo-advisory firms currently in the market. You see that there are robo-advisory firms doing business to consumers or B2B kind of businesses, and companies that instead are doing portfolio management, digital brokerages, and so on and so forth. So part of my research agenda is really trying to understand what are the pros and cons of robo-advising for individual investors. I already have a paper in the RFS. The title was The Premises and Pitfalls of Robo-Advising. And here we were analyzing sort of a primitive form of robo-advisors. And what we were finding is that in many cases, there were some cases where the individual investors were actually benefiting from adopting robo-advisors, but for the majority of the cases, the people that were already diversified, they were not really benefiting much from getting access to this new tool. And one of the problem with that paper was that we were focusing on individuals that were stock traders, so they were for the most part in investing in individual stocks. And so one of the biggest concern is that the majority of robo-advisors in the US and all over the world, they are now focusing instead of in index investing in ETFs and index mutual funds. So this is where this paper, Who Benefits from Robo-Advising, really come out of. And more broadly, I think that the broader research agenda of mine trying to understand how much complementarity and substitutability there is between man and machines, and more deeply, what do investors really care about when it comes from financial advice? And I have a paper on this is called The Needs and Wants in Financial Advice, Human versus Robo-Advising, where exactly we try to understand what are the underlying needs and what aspects of advice in individuals value the most. Now, but let me just jump into today's paper. So this is going to be based on an analysis of the Vanguard's personal advisory services. This is the largest hybrid robo-advisor in the world. It has, and I think this is a little bit outdated, it has probably now 150 billions of dollars under management, and it has experienced an explosive growth since its inception. So in a nutshell, what we're going to do is try to understand what is the effect of robo-advising on the portfolio allocations of the individuals, and who benefits more for adopting these kind of tools. Before getting into the data, let me just give you the key features of how the tool works. So if you were an investor at sign up, what you would do, you would get profiled on your risk tolerance, on your investment horizons, and your demographic characteristics. And the robo-advisor would design a comprehensive financial plan for you. This would be a recommended portfolio strategy, the cash flow forecast, and the probability of securing a retirement where you can spend as much as you were planning to. Now, a key step is that before the approval, the clients will interact with a human that explains the plan, and it tells them exactly what is the portfolio allocation means and how it's going to evolve in the future. And after the approval, you're going to have that the tool will trade automatically. So this is not a advisory of a robo-advisor that tells you what could be certain portfolio allocation that then you will go ahead and implement by yourself. This is a tool where the individual, once they sign up, they are basically on rails, right? So the tool will trade for the individuals without requiring any kind of approval at each point in time. It's going to be rebalancing quarterly. So there's going to be no control from the investor effectively. So why is this setting unique? Well, because post-enrollment, if you think about it, what will happen is that your portfolio allocations are going to change mechanically. So depending on your characteristics, you're going to have pre-specified schemes, and individuals are going to be assigned to these categories mechanically. So what the effect I'm going to document today, you can think of them as quasi-exogenous, because if you think about it, we're going to see these massive changes in the portfolio allocations, and people that are going to be in the same group, they're going to be reallocated exactly in the same way. So it is inconceivable that individuals, when they sign up, will move exactly their portfolio allocations in the direction of the robo-advisor. And the crucial aspect of the machine learning here is that we're going to try to understand the heterogeneity of the effects across investors. And this is going to be potentially also useful into understanding what would be the effect on the general population that did not decide to sign up, effectively, because if you can map or have the same type of characteristics, I could tell you exactly what the robo-advisor could do for you. And the machine learning is also going to tell us how much the nonlinearities in your characteristics are going to be important in determining the effects of the robo-advisor. Now, in terms of the main findings, what we're going to find is that we're going to document a huge increase in the bond holdings by individuals, and a huge decrease in cash, and not much of a change in terms of the equity holding. We're going to see a big changes in the investment vehicles. Mutual funds holding is they're going to increase, and individual stocks and ETFs instead are going to be decreasing. And then we're going to see three things that I think are very important. One is going to be a huge increase in the indexation. So individuals tended to be in active mutual funds. They're going to be now placed in index mutual funds. As a result, you're going to have that the fees they're going to pay on their fund holdings are going to decrease. And you're going to have a big jump in the international diversification, which is one of the biggest concerns that people tend to have regarding the portfolio allocation of US investors, that they do not tend to be international diversified. And we're going to find that the performance is going to increase, mainly because the volatility of the portfolio of the individuals is going to decrease, not so much because expected returns are going to increase. In terms of the heterogeneity of the benefit, we're going to find that those individuals that had high cash holdings, that were trading a lot and had little experience, are going to be benefiting a lot. And instead, the ones that had a high share in mutual funds and high indexation, almost you can kind of think about it, it would be the natural thing. They're going to be benefiting the least, simply because they're going to be put in portfolio allocations that are going to be very similar to that. Now, let me start with telling you a little bit about the data. So we have 350,000 investors, and we have their trades, their positions, their demographic characteristics, and we can then merge together mutual fund characteristics and return, as well as stock characteristics and return. So we can know exactly at each point in time what are the characteristics of these individuals and how their portfolio allocation change over time. Just to give you a sense of the demographics, and this is going to be very vanguard kind of representative, but not necessarily US representative. We're going to have that the average individual has 63 years old of age, 50% are going to be male, and the people before signing up, they were with Vanguard for approximately 14 years. So they were self-directed investors for 14 years before signing up for these robo-advisors. In terms of the characteristics, the wealth and the portfolio allocation characteristics, we have that they are relatively wealthy individuals, approximately $600,000 in wealth. They have 8 assets on average, and their split is approximately 50-20-20. So they have 54% of their wealth in equities, 24% of their wealth in bonds, and 22% of their wealth in cash. And in terms of portfolio allocation, they already actually have, before starting, so before sign up, they actually have already a pretty good portfolio allocation when it comes to the vehicle they use. So they have that the 72% of their wealth is in mutual funds, 20% is in cash, and we have that only a very small fraction of them were holding stocks and ETF. And in terms of indexation, 50% of their wealth is already in index funds, and there is very little exposure to international funds. So only 10% of the wealth is in index funds, and we have that almost no exposure to emerging funds. But the truth is that many international funds have some emerging country exposures. So you actually can imagine that they would be already somewhat exposed to emerging funds, but very little. So, but if you look at this picture, this is the picture of individuals that are already investing relatively well. So they are already individuals that have put their wealth into mutual funds. This is very different compared to what you would see if you were taking the brokerage accounts of other firms like Schwab or TD Ameritrade. You would see that these individuals instead would hold way more individual stocks. So if anything, I think that the results we're going to document here are going to be a lower bound of what would be the effect on the broader population. Now, in terms of what happens to the bond share or to the various other characteristics as soon as the individuals are signed up, you're going to see these massive changes. So this is what I'm depicting here. I have a graph where on the y-axis I have months before signing up, and then I have on the x-axis, and on the y-axis I have the bond share. What you see is that the average individual has approximately 25% of the wealth in bonds, and this skyrockets to 40% as soon as they enroll. And second thing I want to kind of show you in terms of also how this kind of the cross-sectional variation changes. So here I'm depicting the mean as a 95% confidence interval. Here instead, I'm depicting the median in blue and the 10th and 90th percentile bands. What you'll see is that after sign up, you're going to see a homogenization. So before the 10th and 90th percentile, we're going from 0 all the way to 50%. And then instead, now they're going to go from 50 to 50%. In terms of indexation, you're also going to see this massive change. We go from 50% all the way to 85% of indexation. In terms of international exposure, once again, you go from 10% to 30%. And this is, once again, if I depict the median as well as 10th and 90th percentile, you see the homogenization. After the implementation of the robo-advisor, you have that these portfolio allocations look more similar to each other compared to before. And this is what happens also to the fees that individuals pay in the mutual funds they hold. They go down, and this is nothing else but the byproduct of the indexation, the fact that they are put now in index mutual funds. Now, one thing that I want to motivate a little bit is the fact that in terms of equity share, what you will notice is that there is if I was depicting the averages, you would see there is very little changes. They go from 60% to maybe 58%. But this, of course, is hiding very big cross-sectional variation. So if I was showing you what would happen to those individuals that have very low equity share before signing up, you'd see that they go from 0 all the way to 50%. And instead, for those people that instead have very high equity share that were between 90% and 95% of equity share before signing up, they instead drop to 70% right after the implementation of the robo-advisor. And so one thing that we wanted to do here is try to understand how can we kind of, instead of doing this piecemeal one-dimensional growth, can we actually represent what would happen to the portfolio allocations of individuals as well as to the investment performance after signing up? So in principle, it's not clear ex ante what investor characteristics would be relevant. In principle, if we had access to the actual algorithm, we could back it out, but we don't. And so there is no kind of theoretical reasons why some of the characteristics would enter linearly or non-linearly, or if there were interaction between some variables at hand. So one approach would be to Lagrange kitchen sink regressions, which are potentially likely to overfit. But what we said do is to use a machine learning tool known as booster regression tree and let the data speak. Now, machine learning, why are we using it in this case? Well, we know that machine learning tools are likely to outperform traditional statistics if you have very large set of explanatory variables, if you have that there is potentially no linear relation between regressors and regressors, and you have many interactions between the regressors themselves. And as data or big data sets are becoming bigger and bigger, we have more and more conditional information. We tend to have that machine learning are gaining momentum in finance and economics. Now, in terms of the non-exhaustive list of the more to less familiar kind of tools that are available to economists, we go from ridge and lasso to bagging, random forest. The one we're going to be using today is booster regression trees, and then we're going to have neural networks. The advantage of booster regression trees is that not only it's going to be pretty good in modeling the effects of the robo-advisor on the individual, but we also going to have that it's going to be very economically interpretable. So let me give you a very quick primer of what regression trees are. So this is, I'm going to go very quickly here, but a regression tree, you can simply write it as a set of disjoint regions spanned by the regressor variables and a constant associated with this region. Now, when I show this kind of formula, people, they get relatively confused, but if I was showing you a picture, it would make much more sense. So I have here the fit of a regression tree as the y variable is one that I want to explain. And then I have as regressor variables x1 and x2. The game here is going to kind of construct a fit by using partitions that are partitioning, doing recursive partitioning that uses lines parallel to the coordinate axis. We're going to do it in a recursive way. One of the problems with regression trees is that they tend to be very hierarchical. So what you tend to do is you first decide on the first split, which in this case tend to be around at the X1 axis. But then you go into the subregions to the left of X1 and to the right of X1, or in this case, T1, and you try to find what the subregions can be further split and in order to diminish the empirical error of the model. But the problem is that you tend to use less and less data, and you tend to overfit as you go into the tree. Now, what is boosting? Well, boosting is nothing else but the sum of these regression trees. And the idea is that at every boosting iteration, you fit a tree on the current residual. So at each point in time, you're going to fit a tree. You're going to have to decide on the optimal split in regions and the optimal constant. Now, just to give you a very quick visual idea of how boosting will work, see, this is in a one-dimensional setting. Suppose that I have the true data generating process is this black line. If I was fitting a linear model, you would find that, of course, you would not capture all the nuances. With one boosting iterations, I would have that the dependent variable is modeled as a constant to the left of this splitting point and to the right. If I have 5 boosting iterations, you're going to see that the fit is going to be much better. And if you start doing 10,000 boosting iterations, you're going to get that the fit is going to be much better. Of course, this is something that would work with any non-parametric method in one dimension, but the advantage is that what boosted regression trees do nothing else but what we say cheat the curse of dimensionality and are able to model these non-linearities when you have multiple dimensions. And why is it that boosted regression trees don't overfit? Effectively for 3 reasons. Because they fit small trees, they do shrinkage, and as well as subsampling. Now, are they black boxes? The answer is no. There's going to be a lot of intuition that can come out of it because of 2 main tools. One is going to be the relative influence estimates, and the other is going to be the partial dependence plots. The relative influence estimates is just going to tell you which variables matter the most. On the other hand, you're going to have the partial dependence plots are going to tell you what is the functional relation relating each the regressant to each of the regressors you have. Now, let me just show you kind of how we apply this tool in our context. So we focus, for example, in this case on the equity share, and we work with 10,000 boosting iterations, and we're going to be using all the covariates that I showed you in the summary statistics: the age, the gender of the person, the tenure, as well as the portfolio location and the trading characteristics of these individuals. And what matters in terms of changing the kind of allocation to equities of these investors? Well, effectively, what will determine everything is the equity share that the individual had when they were signing up, their age, and the percentage they had in cash. So this is an example of a partial dependence plot. The way you'll read it is that here, the person that logged in or signed up with 0% in equities, they would now have 30% equities added to their current portfolio location. And instead, those people that had 100% in equities would see their equity share decrease by 30%. And what you'll see here in terms of the age, I think is very interesting, is that you tend to have that those individuals that were between 20 and 40 years old actually they see an increase in their equity holding. Instead, those that are instead in their 80s and 100s, they see a decrease in their equity holding. And instead, those people that were approximately 60, they actually don't see much of a change. And this is kind of what you see here is this is nothing else but undoing what one of the common mistakes that people do. We know from the behavioral finance literature that individuals tend to be too little exposed to the stock market when they're young and too exposed to the stock market when instead they're old. And this is just what would be a partial dependence plot in a bivariate setup. Would I get the same answer if I was using a linear model? Well, the answer is no. I would actually find that the male and the married dummy would be significant. And this is mainly because the linear model would not be able to capture these non-linearities. So if I was doing a kitchen sink regression, I would actually argue that the male and the married kind of status of a person is important for the changes that the robo-advisor operate, but this is actually not what is the case. Now, the second question we ask is, do we see a big change in performance when you have that people sign up for this portfolio allocations for robo-advisor? And the answer is yes, you do. You see this, we are computing realized Sharpe ratios. Time zero is the time where the investor actually sign up. What you'll see is that there's going to be an increase in, or effectively a positive effect on the Sharpe ratio. If you decompose though the return from the volatility, you'll see that there is almost nothing coming from the expected return. Everything comes from the volatility that is decreased once the individuals sign up for robo-advising. Of course, one of the problems that this result have is that they do not control for the fact that individuals endogenously decide to sign up. So people who do poorly may be the ones that decide to sign up. So the performance improvement may be overstated. So we have actually an identification strategy in the paper where we construct counterfactual returns for those who sign up, for those periods where they were not signed up, and we can actually confirm that the results or the baseline results go through. But in the second step here, one thing that I want to kind of highlight is that, of course, on average, you're going to see a big improvement in performance. But if I was to do the within individual changes in this performance, of course, I would have a big dispersion. And this is what I'm representing here. I'm showing you the within individual changes in abnormal Sharpe ratios. Of course, if there was no improvement, you would actually expect this density to be centered around zero. Instead, what we find is center around a positive number. But then for us, the interesting thing was to try to understand which individuals end up in this region and which individuals end up in this region, trying to understand effectively the heterogeneity in the improvement in performance that these robo-advised individuals end up having. And this is exactly what we do here. What we tend to find is that individuals that had a high tenure, they don't improve that much, possibly because they were already investing their portfolio allocations according to, they were invested probably using index mutual funds and so on and so forth. Individuals that have high cash holdings benefit a lot. Individuals that had high mutual fund holdings benefit little. The people that were trading a lot benefit, and the people that instead had a lot of indexation, they don't. One, I think, interesting non-linearity you'll see in the number of assets. And those people that had 30 assets or 1 or 2 assets are the ones that benefit the least, most likely because these ones were the ones that were maybe investing in index funds, and this one instead, the ones that were investing in a plethora of stocks. But the one that benefit the most were the ones that were probably the stock traders that were only having 10 or 12 stocks in their portfolio. Now, in the rest of the paper, what we do is we go beyond performance. So here I'm just going to show you one result related to attention. What you find is that as soon as investors sign up on the month of signing up, they pay a lot of attention to their portfolio. So they log in very often, but over time, this attention goes below their average. The idea simply means that once at the beginning they tend to control or to try to monitor the robo-advisors, you're going to have that over time they're going to spend less time thinking about their finances. And this is true whether I'm working with the attention through a desktop computer and or if I work with attention through the mobile app. For the mobile app, I think the interesting thing about this, what you're going to see is that the number of logins, they're going to be instead increasing and staying high. And the idea is simply here that individuals will tend to kind of log in more quickly simply to see how their finances are doing, but they will not have to spend time thinking about their portfolio location or the next steps for what they're going to do with their portfolio going forward. Okay, so if you are interested in the paper, you're going to find additional results on the determinants of robo-advised sign up and as well on attrition. And then here, most of the emphasis is going to be on the role of hybrid form or advice. So what we find is that the majority of people that actually stay with robo-advice are the ones that tend to have a hybrid form so that they can kind of relate to individual advisors while being in a robo-advisory environment. Now, let me conclude. So I think robo-advice has the potential to tremendously benefit investors. It really has the potential to disrupt the entire financial advisory industry. I think that most of the robo-advisors are still rather simplistic, maybe for good reason, but I'm very excited to see what the other authors have to say about the implications for financial inclusions, as well as the evolution of the algorithms underlying robo-advising. Now, I'm going to stop sharing. And I see that I have a bunch of, okay, so I'm going to start from the bottom, given that I have Runjin Lu as, and I'm going to be only, I'm sorry, we are also running a little bit of time. So I'm going to, for those people that I don't answer the question to now, I'm going to kind of send you emails personalized with the answers. But kind of starting from the bottom, Runjin Lu is asking, I wonder how much of the results obtained here depend on the underlying algo employed by Vanguard. Is it possible to gauge how similar Vanguard robo-advisor algo is to other major platforms? I think that this is obviously a concern. I mean, of course, we're going to have that if different robo-advisors have a different implementation, you may have that the results may be different. And then I think this is partially why I think that this literature needs to grow into analyzing how different algorithmic approaches to robo-advisors can be useful, right? In the paper I have with Francesco Da Junto, we worked with, and Prabhala, we have a very different robo-advisor, and we actually find that the fact that we give too much discretion to individuals is such that individuals tend to use it the robo-advisor too often, and they tend to kind of hurt themselves by just over-trading or overusing the robo-advisor and paying too much in fees. But okay, I see that there are two questions, two raised hands. So let me first unmute Vicky.
Oh, hi.
Vicky, you can.
Yeah. So my question is about, you know, so those people who sign to robo-advisor, so the advice that robo-advisor give them, how much different from their retirement account? Is this kind of right? Because that's, you know, kind of, I want to know what kind of new information they can get from signing into this, than just, if it's just a copy of the, you know, retirement account based on their profile, then they kind of know what they're signed up to.
Yeah, no, I think that, okay, so I agree. So you basically have two things. So, I mean, in this case, and actually I should do, so I can actually see retirement and non-retirement accounts. And so I can actually see what kind of the differences are in terms of the implementation. But one of the things that I think is very important is that it is actually, so Utpal Bhattacharya actually had a paper that I think is very interesting on this respect. So it is actually very hard for individuals to implement this advice by themselves. So even if you show individuals what is the optimal allocation, they actually don't implement it on their own. So like, I think that there sometimes as a professional, we think that individuals may be more sophisticated than they really are in the ability to understand exactly what should be done. But I think by your point is very well taken. Okay, so let me get to Alessandro, and then I'm going to have to cut it short. Otherwise, I'm going to steal time from Michael. Go ahead, Alessandra. Oh, wait a second. I think I unmuted you, but I don't think you're mute. Wait a second. Okay,
Hi.
go ahead. You can talk.
Hi, Alberto. Nice paper. I have one question. So if I look at the population and the age being 62, I know definitely there is something to say in terms of retirement versus non-retirement account, but it's just, I think the age is also be a key determinant here of the choices. So it's not just that these people have good portfolios, but these people maybe are transitioning into retirement, or some of them are already retired. I think it's something worth investigating more.
Yeah, no, I think that is a very, very good point, and I think that's actually crucial. And yeah, yeah, that's a very good point. And we bunched them all together, and but I think there is definitely something that we can do and exactly see how much of a benefit you see when you, and how important it is in the kind of transition into retirement. Yeah. Thank you. So I think before I've given that is Miss here. So Zun Liu is asking, you mentioned 150 billions in 350,000 investors. No, I think there's actually a very good point, Zun. So we actually have 120 billions of the people that actually end up signing up. So one thing that is kind of interesting in our setting is actually we can see all those people that were interested or were contacted for robo-advice, but actually did not sign up. The people that were that decided to sign up in the end were approximately 80,000. But let me quit here, otherwise I'm just going to be taking too much time. Let me move on to Michael. Michael, feel free to kind of share the screen and start. And apologies for the delay. I think you're still muted, Michael.
Yes, yes.
Okay,
Can you hear me, Alberto, and anyone else? Okay,
yeah,
thanks
you
so
can
much.
go ahead. Perfect.
Okay, thanks so much to Alberto, to Rina, to Anna, and to all the other organizers at Georgetown for putting this on. It's a really great resource. And thanks to all of you who are tuning in today to watch. My name is Michael Reher from UC San Diego, and today I'm going to talk about my paper, Does Fintech Democratize Investing?, which is joint with Stas Sokolinsky at Rutgers Business School. The broad motivation for our paper begins with the observation that wealth inequality has really surged over the past 4 decades. And it's becoming increasingly recognized that less wealthy households actually earn lower returns on their financial assets relative to wealthier households. And in fact, only a quarter of those households outside the top 20% of the wealth distribution own stocks at all. Today, we're going to ask whether technological innovation in finance can reduce inequality in financial returns by giving modestly wealthy households access to asset management. And to prime the pump a little bit, let me begin with an amusing quote from a recent Economist magazine article. The article writes, "The wealth management industry stratifies customers in a manner similar to airlines. High net worth clients fly business class, picking stocks and chatting with named advisors. Cattle class gets no service at all. Technology is conspiring to change that." So in this paper, we're going to study robo-advising as asset management for the so-called cattle class. The product we'll study is a well-diversified and automatically rebalanced portfolio. And as Alberto mentioned, what's unique about robo-advisors is that they rely on automation to manage these portfolios. By relying on automation, these advisors actually have low per portfolio management costs. That allows them to accommodate smaller portfolios. In particular, we'll study a reduction in account minimum by a large US robo-advisor from $5,000 to $500 in 2015. This reduction is actually pretty big when you consider that the median US household actually is only $17,000 in liquid assets. So put differently, this means that prior to the reduction, half of US households would have had to invest roughly at least a third of their total liquid wealth just to get access to the robo market, this robo-advisor. We'll study in this paper what the effect of reducing this account minimum is on modestly wealthy households' financial condition, where we'll define modestly wealthy in a few slides. As a first step, we need to ask whether this reduction brings modestly wealthy households into the robo market. More precisely, what we mean is, does it relax constraints on their ability to invest with robo-advisors? Second, by entering the market, do these households' financial condition improve? We find that the reduction indeed democratizes, so to speak, the robo market by bringing middle-class households into the robo market. As I'll talk about in a few slides, we're going to define the middle class as households from the second and third quintiles of the US wealth distribution. These households are 15 percentage points more likely to participate after the reduction in the account minimum. And we provide quite a large battery, we perform quite a large battery of tests in the paper to assess what the relevant channel is, and all of them seem to suggest that this works through relaxation of investment constraints on these middle class households. Subsequently, they experience a 2 percentage point increase in expected return on liquid assets relative to the upper class. And in this sense, the reduction lowers inequality in return between the middle and the upper classes. Notably, however, there's no effect on the least wealthy 20% of US households. And in this sense, the democratization is partial. Therefore, we'll interpret the reduction as a Pareto improving technological shock. Now, this actually contrasts with the canonical view of active asset managers as introducing large inefficiencies into the market. However, even though the shock is Pareto improving, it has an ambiguous distributional effect in that it appears to favor the middle class over both the lower and the upper classes. The theory that we have in mind begins with the idea that asset managers require some account minimum to, say, cover fixed costs of portfolio management. Households would like to allocate some share, let's call it omega, to asset managers. We might think of this omega as solving a portfolio choice problem where households have a special preference for delegation. They can in principle manage their money on their own, but it reduces their stress or otherwise provides them a benefit when they delegate to an advisor. And this is consistent with the fact that most households who do participate in the stock market overwhelmingly do so through delegation. The account minimum will constrain households' ability to invest according to wealth. Now here there are two cases. First, households may just not have enough wealth to overcome the minimum without borrowing. Second, they may have enough wealth to actually overcome the minimum, but doing so would require investing so much to the asset manager that they prefer not to do so. Enter robo-advisors who use automation to reduce the account minimum to some lower level of little m, less than big M. In theory, this reduction should increase robo-participation by constrained households who come from the intermediate levels of the wealth distribution. These households were formerly constrained by the account minimum, but afterwards they are not constrained. However, there's no effect on wealthier households, these so-called upper class, because they were never constrained in the first place. And likewise, there's no effect on poorer households because even the lower minimum represents such a high level of investment that they prefer not to invest. Our data, we're going to test this theory using data from a major U.S. robo-advisor called Wealth. The Wealth Fund is a bit different than Vanguard in that it's what we might call a pure robo-advisor, and that there's no option for a human advisor. If you try and call Wealth Front, they'll kick you out and fire you. Why? Wealth Front offers an automatically rebalanced, I don't mean to use the word pejoratively, but it's kind of a cookie-cutter portfolio of 10 ETFs that span 10 asset classes. The portfolio weights are determined by the response to a risk tolerance questionnaire. And importantly, investor sophistication will not affect the robo-return because of this feature. Well, you can be the most sophisticated investor on earth or a dummy like me. As long as you provide the same responses to this very basic questionnaire, you'll receive the same portfolio. The management fee charged by Wealthfront is 0% for accounts under $10,000, which are going to be the focus of our analysis today. And for larger accounts, there's a small 25 percentage point management fee, 25 basis point management fee. The particular data set we'll work with is a panel of Wealthfront clients' weekly deposits over 2014 to 16. And recall that the reduction occurs in 2015 in the middle of this period. In our data, we observe demographic information about the household, such as their age, income, home state, and liquid wealth, where liquid wealth is defined as the sum of cash, stocks, bonds, 401k accounts, IRAs, and certificates of deposit. This figure plots the wealth distribution of robo-participants before and after the reduction. We see here that there is a sharp leftward shift in the wealth distribution of robo-participants. In particular, new robo-participants, those who join after the reduction, are much less wealthy than those who are existing participants. Relative to the US population, most of the new robo-participants come from the third quintile, and in relative terms, the second quintile of the overall US wealth distribution. So the way to interpret this figure is on the x-axis, we plot each quintile, each of the 5 quintiles of the US wealth distribution. On the y-axis, we plot the share of robo-participants, that is Wealthfront participants, from each of these 5 quintiles. Okay, and again, the growth in robo-participation is greatest among the second and third quintiles of the US wealth distribution. We'll call these households the middle class, and we'll call households from the 4th and 5th quintiles the upper class. Note that there is no effect on households from the bottom quintile, poorest 20% of US households. This is the sense in which the democratization is partial but incomplete. Turning to the dynamics, in this figure we plot the log new participants from the middle two quintiles and the top two quintiles over time. I will notice here that exactly coinciding with the reduction, there is a sharp increase in the flow of new participants from the middle class. Note that we're plotting a flow on the y-axis, and therefore the fact that this variable remains elevated throughout the observation window means that this shock is likely to have long-term effects. In terms of what the relevant mechanism could be here, in this figure, we plot the share of initial deposits that are exactly at the previous minimum, $5,000. In the blue line, we see that the middle class exhibits bunching behavior, in that 60% of initial deposits from households from the middle class are exactly at $5,000 leading up to the reduction. After the reduction, however, there appears to be evidence consistent with the relaxation of constraints, such that these households stop bunching and instead exhibit the same behavior as the upper class households. As I'll show you in a few slides, these 60% of new middle class households that were formerly right at $5,000 are replaced with a share of households, or replaced with households who invest under $5,000 but greater than $500. This provides some suggestive evidence that the reduction works by relaxing investment constraints on middle class households. That's the intuition that's suggested by the graphical evidence. And to identify whether this investment constraints channel is indeed relevant, we're going to estimate the following regression equation. The outcome, nu I, is an indicator for whether household I becomes a robo-participant after the reduction as opposed to beforehand. Middle I is an indicator for whether I belongs to the middle two US wealth quintiles as opposed to the upper. You recall there's no participants from the bottom quintiles, so they're not in the regression. Now, within this regression, there's a latent first stage, in that we'd like to regress some unobserved variable called constrained I, an indicator for whether I is constrained, on the middle class indicator. So we can think of middle as a proxy, or using the word a bit loosely, an instrument for this unobserved constraint. Our identification assumption is that conditional on observable characteristic X, factors that affect whether a household is constrained do not correlate with other unobserved factors that affect whether a household becomes a participant after the reductions as opposed to. In our setting, X will include the household's age, income, state of residence, and subjective risk tolerance. We'll perform a wide battery of tests in the paper to evaluate the validity of that assumption. I'll talk about a few of those tests in a few slides, but before doing that, let me show you the baseline results. The result in column 1 means that households from the middle class are 14 percentage points more likely to become robo-participants after the reduction as opposed to before the reduction relative to upper class households. To evaluate whether this middle indicator is a reasonable measure of whether a household is constrained, we'll regress several other reasonable measures of constrained investment activity on middle. In the second column, we see that households from the middle class are 30 percentage points more likely to invest under the minimum after the reduction relative to households from the upper class. And this makes sense because if they were no different in their propensity to invest under the minimum relative to the upper class, it would suggest they're investing because this is kind of like a hip or a cool or a fun thing to do, but rather the fact that they're investing under the minimum suggests that they are experiencing a relaxation of constraints. In column 3, the outcome is going to be an indicator whether household I is an imputed non-stockholder. And the result here implies that households from the middle class are 43 percentage points more likely not to own any stocks before the reduction. That is 43 percentage points more likely to be making their first investment in the stock market. This makes sense because if middle-class households participated in the stock market at the same rate as upper-class households, it would suggest that their preference for delegation is sufficiently low that they could have replicated the robo-portfolio before the reduction and thus were never constrained. I should note that I'm using the word imputed stockholder or non-stockholder because we observe the level of a household's liquid assets, but we don't observe the composition. Therefore, we're going to impute whether I is a stockholder using observable characteristics in our robo-advisory data set and the nationally representative survey of consumer finances. And we'll perform the imputation using a variety of traditional and machine learning-based algorithms such as those that Alberto just described. In column 4, we're going to consider a kind of intertemporal measure of constraints. We'll consider an indicator for whether I is a millennial. I call these an intertemporal constraint because households may be constrained by the minimum, but the middle class may be constrained just because they're too young to have accumulated enough assets to overcome the minimum. But at a later stage in the life cycle, they would have accumulated enough assets to overcome. Now, this still represents a form of constraints, but it's a weaker form of constraints. Nevertheless, we find that new middle-class households are no more likely to be millennials relative to new upper-class households. Sometimes there's no change in the age, there is a change in the wealth of households who are robo-participants. This suggests that the intertemporal constraints channel is not the dominant channel here, and in some sense, what the reduction is doing is it's relaxing constraints on households who would otherwise be permanently constrained by the minimum. Briefly, we can estimate an analogous panel regression that allows us to assess whether the results could be driven by heterogeneous response to news articles or blogging activity, as in column 1 here, or to more rigorously evaluate the scope for pre-trends, as in column 2. Now, to be clear, the core parameter that we're focusing on here is the share of robo-participants who were formerly constrained by the minimum. A cousin parameter to that is the share of U.S. households who become robo-participants. Now, the first parameter is more relevant for our focus, given that we're interested in the effects of private fintech. The second parameter would be more relevant for someone who's interested in, say, a publicly subsidized or public rollout form of robo-advising or some kind of national cap on account minimums, neither of which seems to be likely to occur in the near future. Nevertheless, we can still make progress on estimating this cousin parameter by partitioning the US population into cohort C, where one example partition might be a 10 by 10 by 10 grid according to wealth decile, by age decile, by income decile. Then we can estimate the elasticity of the share of households that become, of US households that become participants by estimating the following regression equation, where we'll regress log new robo-participants from cohort C in week T on an indicator for whether cohort C falls in the middle class times post T. This will recover the elasticity of the share of households that become robo-participants. We can't estimate the share itself because, of course, we don't observe the investment behavior of all households in the US. Nevertheless, the positive and significant point estimates from this regression suggest that the share does indeed increase, and the results are not sensitive to how we partition the US population issue. Now, when we're talking about, or we're thinking in terms of aggregate quantities, we might also ask whether the observed increase in middle-class households' participation with our robo-advisor, the robo-advisor we study, might actually involve a reallocation from a household's decision to turn down an unobserved investment opportunity with a competitor. So instead of investing with, say, Vanguard PAS or Betterment, the household invests with Wealthfront. This is a tough question to address, given unless you have data on every single robo-advisor in the US. The best we can do is to work with, albeit spottedly reported data from the SEC on total client base at US robo-advisors. This data is admittedly a bit coarse, but it's really the best we can do, and it's the only publicly available data that exists on total client-based enterprises. Nevertheless, the flat red line here indicates that the results do not operate through a reallocation away from competitor advisors, here defined as betterment and personal capital, towards Wealthfront, towards the advisor with reduction. Now, turning to the impact on welfare, we'd like to estimate the effect of this reduction on formerly constrained households' total return on liquid assets. To begin, let's write down the following two-period equation, where some portfolio outcome y in period big T depends on the middle indicator times post big T. Now, big T here will equal 1 for the post period, and it'll equal 0 for the pre-period. Taking differences leads to the equivalent first difference equation, where the outcome is delta y, the change in some portfolio measure. As a necessary first step, delta y will equal the change in risky share. To a first order approximation, the change in risky share equals the post-reduction investment by household I in Wealthfront divided by the household's liquid assets. The outcome we're really more interested in is the change in total return. It's defined as the change in risky share times the risky return for household I's robo portfolio. Now, following convention, we'll measure the risky return using the expected return implied by a variety of benchmark asset pricing models. Now, here there is a separate question of whether an increase in total return is welfare improving. We're going to argue that the answer is yes, in the sense that the robo portfolios in our data are very well diversified. The share of idiosyncratic risk in these portfolios is very low. And in fact, is consistent with the results that Alberto just presented on the diversified nature of robo portfolios. That said, any question on welfare comes with caveats, right? We need to know, we would in principle need to know something about the correlation between labor income and the robo portfolio and the household's risk preferences, et cetera, et cetera. But we believe that the very well diversified nature of robo portfolios and the fact that they conform with any textbook advice you would give a retail investor means that an increase in total return is likely to be welcome. The results are shown in column 3 of this table. In particular, we find that new middle-class robo participants experience a 1 percentage point increase in total return relative to the upper class. Now, the results are particularly strong when we look at households from the second quintile, as opposed to the third quintile of the U.S. wealth distribution, whom we'll call the lower middle class. They experience a 1.9 percentage point increase in total return. And given that many of these households did not participate in the stock market at all before the reduction, this increase in total return is likely to represent a very large relative increase in total return on liquid assets. And this brings us back to the paper's initial motivation. We found that this shock that reduced investment constraints on households' ability to enter the robo market raised participation and expected return for the middle class relative to the upper class, but it had no effect on households from the poorest 20% of the U.S. wealth distribution. Therefore, we interpret this shock as a Pareto, we interpret the reduction in robo-advising more generally, the Pareto improving technological shock, which interestingly actually contrasts with the canonical view of active managers as imposing inefficiencies on this market. However, it has an ambiguous effect on wealth inequality in that it appears to favor the middle class over both the upper. Thank you so much for tuning in. And now let me address some of the questions that that popped up. Give me 1 second. Let me first address those that come from people who have raised their hands.
Yeah, Michael, I can read them for you. Don't worry about it. I can start from the bottom. So I think that Mulikaryun Bhat is asking, what is the tenure of investments when the minimums were lower? A year or more?
That is a great question. Tenure of investments. Let me the tenure of investments. So actually, likely to be quite small because Wealthfront actually only began in 2008. The shock occurred in 2015. We don't, it's a statistic I don't know off the top of my head, although we can check. So the thing that's important to point out is we have information on active clients, people who were depositing funds with Wealthfront between 2014 and 2016. So conditional on being on our data, the tenure is unlikely to be much more than a year. Actually, 80% of existing participants in our data made their first deposit between 2014 and 2016. So 80% of the existing participants had a tenure of 1 year or less, and 20% had a tenure.
Okay. And sorry, Michael, we have a question live from Alessandro Previtero. Remy,
yes, please.
Go ahead, for Alessandro.
Hi, Michael. Thanks. Very, very nice paper. So I really applaud your effort of trying to complement the data you got here. But I just warn you that maybe welfare implications are very difficult to draw in this setting for two reasons. The first one is you observe only the portfolio that the investor have with Wealthfront. So you don't know if they're doing anything else to offset the risk taking in any other domain. And the second one is also, we don't know anything or enough about the time series property of joining robo-advisor. So between 2014 and 2016, you had positive stock market returns. So increasing risk taking will pay off. But what if these people that join at this time are going to be the one that are going to exit the market when the market collapses and they're going to sell low?
Yes, that's a great point. And let me address the second part of the question first, and then the first part. So it's a 20-minute talk, so I kind of had to be a bit brief in terms of the results that we show. One thing that we do in the paper is we do investigate exactly this. We investigate the probability that a new middle-class robo-participant withdraws funds relative to upper-class robo-participants. It's actually quite relevant in our setting because in August of 2015, there was a market correction. For all of 2015 before this, it was quite a bull market. But in August, just 1 month afterwards, there was a sharp decline. However, we find that the new middle-class participants are actually more likely than the upper-class participants to remain steady throughout this period. And we also find that they actually are more likely to make a new deposit with Wealthfront. So suggested there, they are persistent investors and have an eye towards the long term. Now, on the welfare point, you're completely right in that making any statement about welfare requires some knowledge about A, preferences, and B, other sources of income. I can say in terms of correlation with other sources of financial income that based on our imputed stock market participation measure, roughly 60% of the new middle-class participants who participate in this market had no exposure to the stock market beforehand. So it's unlikely that this is going to reduce their total return through, I don't know, undue or correlation with whatever else may be in their financial portfolio. That said, one thing we're looking into going forward and taking your point very seriously is to evaluate whether, maybe labor income may be adversely correlated with the robo portfolio. And we can try and back that out based on looking at income over time in the state of residence where the household lives. And we're also going to try and make progress on whether the level of risk is appropriate by backing out what the implied level of risk aversion would be. But these are great questions, and of course, any statement about welfare needs to use the word welfare in CAT's use.
Thank you so much, Michael. I think we are a little bit kind of running behind, so you may have another couple of questions in the chat, but if you don't mind responding maybe via email or through the chat, we can move to the next presenter. If you can stop sharing your screen, maybe I can have Agostino share his screen.
Yes, thank you so much, everyone. I will respond to Mallikarjun and Neil separately.
Perfect. And by the way, Alessandro, also, I completely agree. I mean, there is so many questions that are open in this field. I think that my hope is that we're going to be able to have robo-advising day 2, 3, 4, 5, 6, and on and so on and so forth. That's my hope. But without further ado, let me just leave the floor to Agostino. Agostino, please go ahead.
Okay, perfect. Can you all hear me? Great. Well,
Yeah.
first of all, I'd like to thank Alberto for putting together this great workshop or event, and also for giving me the opportunity to present. And also, I would like to thank Alberto and Rina for setting up this nice online seminar that I think was a great success. I've been following with interest most of the sessions, and they were all well taught. And now back to the topic, I would like to present some work on personalized robo-advising. So this looks mostly at the algorithmic perspective of robo-advising, and it's basically trying to understand what's the optimal mix of interactions between the algorithm and the client. And let's join work with Svein Olafsson and Talia Zarivopoulou from Columbia and Austin, respectively. So let me start directly with motivation. I think Alberto and Michael also already discussed quite a bit about the benefit and advantage of robo-advising. So I will be quick with these first slides. So roughly speaking, essentially robo-advisors are designed to be automated platforms that should provide investment advice using algorithmic tools, and ideally with very little supervision by human advisors. So there have been many robo-advisors that were launched during the financial crisis in 2008, and now we see more and more robo-advising desks within also major broker dealers and banks. And the main offerings that they provide is basically the possibility of joining the investment platform with very low fees, as has been pointed out also earlier by Alberto and also Michael. So you don't need really to have a lot of money in order to start an investment plan, and it's fully automated. So both in terms of constructing the portfolio and also deciding how to rebalance and when to do that. And they also provide a lot of additional services such as tax loss harvesting. So, and in the recent days, they are becoming both day-to-day and long-term money managers. So in the first stage, they were supposed to be primarily planning for helping the clients to plan for retirement. But I think in the recent years, we have seen a shift to robo-advising that also manage checking account or saving accounts or deposit check for clients. The trend has been steadily increasing, meaning I think in at least the last time we checked in 2019, they were managing about 750 billions just in the United States. And it's still a negligible, or small, not negligible, I would say a small fraction of the total assets that can be invested by households, including nearly liquid assets that all the households are investing, but it's still significant because exactly 1.5%. It's designed to increase. If you look at these graphs, these are projections ahead of what will be the amount of assets that will be managed going forward. And I want to, the literature, in my opinion, is not very well developed, and it has, in the sense that it's not, the papers that have been produced are very good and very informative, but I think it's still in the stage of developing. And Alberto has been one of the pioneers in this area, and he has done a lot of interesting work about comparing robo versus traditional advisors, where you have classical customer service representative that basically provides advice to the client, tries to make him at ease and be sure that he doesn't become too worried when the market is going down. We have seen a talk previously by Michael about financial inclusions and democratization. And there have been also some other works, mostly on the practitioner side, that have focused mostly on the risk profiling. So essentially, how do you profile the risk of a client? This typically is based on asking questions when they sign up, and then basically based on this question, try to come up with a recommended mix of risky and non-risky assets. And typically, they all do mean variance portfolio optimization, meaning maybe not just the plain mean variance. They typically adjust it using views such as the Black Litterman, for example, model. But pretty much they all invest using similar technology. And I think there's been a very interesting paper recently by Alberto and Da Cunto, we basically look at what are the main features of advising. Like one of those is the portfolio personalization, which is also one of the motivating aspects of our paper. They also discuss a lot about what's the level of client involvement, both in terms of like discretion on when to override robo-advisor decisions, but also in terms of how to participate in the construction process of the portfolio. And also like to what extent there should be a human advisor that is essentially trying to make, acting, as I mentioned before, as a customer service representative that is there trying to help the client when he's in the need or when he's in a difficult time that he doesn't know exactly what decision to take. So this is basically the state of the art. Now, in contrast to the other papers that we have seen earlier, this is not an empirical paper, so I don't have data to show, but I hope that the implications that we will derive with the model might be later used in order to maybe test the model and some of the predictions that we bring forward. And basically, we are looking at algorithmic perspective for robo-advising, and the focus, primary focus is about investment process that takes into account two important features. First is the time-varying nature of risk preferences. So these risk preferences typically are not static, but they change over time based on a lot of those idiosyncratic reasons, but also more systematic reasons that I will describe. And also, there is also an important part, which is related to personalization, about how much should the client and the robo-advisor interact and how frequently they should do that in order to come up with a good like investment performance and good portfolio personalization. So ideally, what the focus really is about personalizing the portfolio, which will be defined clearly, and basically means how closely the robo-advisor can track the portfolio that best matches the client's profile. And there will be very little involvement of the client. So as also Alberto mentioned in his presentation, there is tendency to like provide full automation and little involvement of the client during the process. So only when explicitly asked or queried, the client should intervene and participate. And in this current framework, there is really no human advising. So there is no role for, as I mentioned before, somebody that is there out trying to support the client in the decision-making process. Okay, so it will be a quantitative model, so I would like to introduce some of the processes or some of the quantity that we will consider. There will be basically two layers in the model. There will be the client that has a risk aversion process, which is basically denoted with this gamma and C. So C stands for client, and then the index N stands for the time. So the idea is that this risk aversion process is not constant, is not fixed over time, but is changing as we go forward. And the client is basically giving information to the robo-advisor at the times where there is interaction. So at the times where the two exchange information. And what the robo-advisor does in the model is to try to construct a model of the risk aversion process of the client. So unfortunately, because the communication is not perfect, these two processes, so the model that the robo-advisor will use to make portfolio recommendation, so the model of risk preferences will not be the same as the actual the model that the client has for his real risk aversion. And in fact, there are two important features that make the two processes distinct. The first is that change to client's demographics, which means idiosyncratic shocks to client preferences that depend on family status, like presence of children and any event that happened to the client. This is not seen by the robo-advisor, but is only seen at the time of interactions. And the second is that the information that the client is communicated to the robo-advisor is suffering from a behavioral bias that we denote by gamma M, and we describe how we model it in the paper. And essentially, these two features prevent the robo-advisor from knowing exactly or from customizing the portfolio precisely to what the actual preference of the client is. And the goal is basically for the robo-advisor to design an optimal investment strategy. So he wants to solve like a problem where he can come up with an optimal investment strategy. And there are three features that the client risk aversion in the model depends to occur. There is, first of all, passage of time. So as the client gets older, he tends to become more risk averse, which is a bit consistent with the first generation of robo-advisors, which were primarily target date funds, basically trying to track the age of the client. Shocks to demographics like have been shown empirically to be also important determinants of preferences of the client. And the third feature that influences the risk aversion is the market returns, but also the economic conditions. So economic conditions, depending on whether the economy is in an expansion or, let's say, recession stage, the market, the Sharpe ratio, but also the preference of the client will actually change accordingly. And there is evidence about that. Okay, so now the bias that we have is measured by essentially how sensitive the risk aversion of the clients is to market returns. So essentially, we compare the expected market return predicted by the model versus the realized market return. And if we see that the expected market return is below the realized, the expected market return is above the realized market return, it means that the market is outperforming the client expectations. Vice versa, if the market return is basically below the expected market return, then it means that the market is underperforming the expectation of the client. And this is essentially how sensitive the client is to this market over or underperformance is exactly a proxy for the behavioral bias. So if the client is very responsive to underperforming or outperforming, it means that he will have a large behavioral bias. So if he communicates preferences to the investor at the time of interaction, he will basically inflate them or deflate them a lot based on how the market was doing. And this behavioral bias in the model are basically assumed, the sensitivity of the client to the performance of the market is assumed to be known and at the outset from the robo-advisor, but in general, how would you construct that is basically related a lot to the literacy, financial literacy. Somebody that is very well aware of how the market works will basically be less sensitive to these fluctuations in the market relative to a young person that maybe has very little knowledge about finance. And there is plenty of empirical literature about how to measure these quantities. Okay, so what are the questions that we try to answer? First we say, okay, the fact that there is stochastic variations in the risk aversion of the client, does it produce any intertemporal hedging demand for the risky asset? Do we see any desire of the client to hedge against risk of future change in the risk aversion? Second question, which is really the heart of this paper, is how can we achieve an optimal level of personalization? So what should be the frequency of interactions that allows the robo-advisor to come up with a strategy that is matching the profile risk of the client as close as possible? And third is, should the robo-advisor always cater to the client's wishes? So if the client wishes to do a specific choice, should the robo-advisor follow the client or should go against the wishes of the client? And we basically quantify whether or not when it's optimal to do one action versus when it's optimal to do the other. So now I want to describe the model. I'm limiting the equations to the minimum, so I just want to give you the big picture. And essentially, we have a model where we model economic regimes that are observable. One could actually easily introduce a hidden regime, but it's not really the main point of this paper. Suppose that you have regimes that are influencing the price dynamics of a stock market index. So we focus basically on a broad market index on which the robo-advisor is investing. And this regime switching model basically is modulating how the price dynamics change. So how does the expected return of the stock in the next period and the volatility of the stock in the next period depend on the current economic condition. So that's the classical Hamilton regime switching model that probably most of you are familiar with. And then we have that risk aversion and market Sharpe ratio are both counter-cyclical. So this means that it tends to be higher during business cycle truths than at peaks. And there is a lot of finance literature that has provided this evidence that when the economy goes down, which means that this economic factor decreases in the current model, then people or clients become less accustomed to the living standards, so they have more troubles to fulfill outstanding obligations, and therefore they will have less tendency to bear risk. So the risk aversion gamma C will go up. And in order to induce them to hold risky asset or risky stock, then the Sharpe ratio, market Sharpe ratio should go up. And this means that because they demand like a compensation for bearing the same unit of risk. And as a result, like the price of the stock will go down. So that's like the story of counter-cyclicality for risk aversion and market to Sharpe ratio. So they go against the economic cycle, business cycle. Now, the advised, unadvised, what we will show is that the unadvised client is inclined, or what is typically the case is that the client that is left alone, that is not advised, typically he will tend to reduce exposure to the risky asset if the market, when the economy goes down, even though the Sharpe ratio of the market is going up, right? If the market Sharpe ratio is going up, and you know that you are like financially educated, then you may not be scared. You might want to hold the risky asset because you are getting higher compensation. But typically, that's what the client wouldn't do, and that's one of the advantage that we claim the robo-advisor can produce with this model. So in order to how do we operationalize all this framework? We consider a mean variance objective for the robo-advisor. There is a single client that the robo-advisor is managing, is maximizing a mean variance trade-off, where what is special about this mean variance trade-off is really this risk aversion process that the robo-advisor is constructing. And this is denoted by gamma and R. And we have that pi is the investment strategy, and X is the wealth of the client. And this is a partial equilibrium model because we are not really endogenizing the prices, so the prices are taken as given. So we are not looking at the last stage of the classical like Campbell-Cochran framework where after the market Sharpe ratio goes up, the price of the stock should go down. And we look at this objective function, and as I mentioned, this is like an adaptive type of control problem because these risk preferences are changing over time. So typically, if you ask me what's the optimal strategy today, and you decide that you solve the problem by finding the so-called control or policy function, you will see that this is inconsistent with the policy function that you will find tomorrow or 2 days from now. And the reason is that, if you tell me tomorrow what you would do given this level of wealth and given this price of the risky asset, this will not be the same as what you will do. This will not be the same function of what you will do 2 or 3 days from now because the risk preference has changed. So, there is a way to solve this problem, which is like in the literature defined to be time inconsistent exactly because it's not the strategy that you have today is not consistent with the strategy you will have tomorrow. And we are able basically to get an expression for the optimal proportion of wealth that has 2 terms that will be elaborated in more detail. But what basically matters here is that you see that there are there is a component that depends on the risk preference of the robo-advisor is constructed for the client, and then there is some relation between the return that you have from the market at the end, if you consider an investment that you do today, versus the current market return, which is basically the variable Zn. So there is some covariation between the two. And importantly, the allocation depends both on the current risk-return trade-off, which is this gamma and R, but also on the future dynamics of the market. So how will the economy evolve and how will the risk preference, the risk aversion process change? And this is this dependent is captured by this conditional covariance and conditional variance terms. So var n is the conditional variance, cov n is the conditional covariance. Okay. So I want to zoom a little bit more on the structure of the optimal strategy because this is related to the first question that I asked. Does stochastic variation in the risk preferences produces an intertemporal hedging demand? And the answer is yes. In fact, the first term of this optimal strategy is basically the classical single period mean variance strategy in the Markowitz model. So you have the expected return divided by the variance. And everything is basically normalized by the risk preference. The second term is the intertemporal hedging component. So here, what we can see is that this covariance is, again, the covariance between the return on the portfolio from tomorrow till the end versus the current market return, which is the return that you have from today to tomorrow. And this is really, this covariance depends a lot on how the risk aversion is changing, because suppose that there is a positive market return, so Zn plus 1 is positive, it goes up. Then it becomes that, then it means that the investor will tend to be somehow less risk averse because the market is doing well. So it will, the corresponding risk aversion process constructed by the robo-advisor will go down. This means that the investor will be willing to take more risk, so he will increase his exposure, his strategy pie on the risky asset. This means that as a result, he will also have a larger return because he's investing more in the risky asset. So that means that this covariance term that you see here, in general, tends to be positive, which means that the investor is investing less today in anticipation of the fact that there will be a positive correlation between the returns that you have in the market today and the future returns. Okay, so then we go back and we look at personalization, I mean the optimal portfolio personalization, which we define to be the difference between the model of the robo-advisor and the risk aversion process of the client. So the relative change, basically, if the robo-advisor is able to construct a process, risk aversion process, which is as close as possible to the client risk aversion process, then he will be able basically to personalize perfectly the portfolio because he can offer to the client exactly what he would intrinsically want. But as you can see, this function depends on two parameters, phi and beta. So phi is the time between consecutive interactions. So essentially interacting more frequently allows the robo-advisor to get to know better idiosyncratic shocks to client preferences, so shocks to demographics. On the other hand, there is this beta component which captures the sensitivity of the client to market return. So how strong is the behavioral bias of the client? And these are essentially the two, the main trade-off that the robo-advisor is facing between acquiring information at a larger rate, which allows him to know better what client is dealing with, versus how accurate is this information, because if I get this information very frequently, it might be very bias contaminated, and therefore I will basically be advising or suggesting an investment strategy which is really far or not close to what the client wants. And what one can show is that if you give me a specific beta, if you tell me how sensitive the client is to realized returns, so what's the strength of his behavioral bias, there will be a corresponding unique value of phi, of how frequent it is to interact. And you can see that this optimal value of phi is increasing in beta. So if you have a larger sensitivity to market returns, then you also want to have less frequent interactions to avoid getting too much behavioral bias from contacting the investor. And this is basically what we see in these graphs. Like here we just plotted for reasonable choices of market parameters for like expected growth rate of the risky asset and volatility. What we would get if you have zero bias, so if the client is really not sensitive at all to market returns, then you want to interact with the client at all times because you want to get this information to be able to capture better idiosyncratic shocks. But as you increase beta, as the client is more and more biased in revealing this information to you, you will see that the optimal time between consecutive interactions becomes larger and larger. And this trade-off is basically capturing, you can see that for instance, if you take any graph, let's say beta equal to 4, you see that interacting very frequently is bad because you get a lot of behavioral bias. And that's the left part of the graph. If you go to the right part of the graph, you see that after some time, if you're interacting too infrequently, then you are not getting to know the specific client well because you don't know what type of idiosyncratic shocks he has been receiving over time. And this effect is also basically, despite that the magnitude of behavioral bias increases with the frequency of interactions, is also related to this concept of myopic loss aversion. So if you have if you interact more and more frequently, then of course you get more and more bias. But if you wait long enough, then typically the market tends to, the return of the market tends to return to their long-term average. And therefore you will have that the level of bias will basically be reduced because at that point, the client will see again the market going back to what it was before. Of course, I'm ignoring here the fact that you might even have, like if you interact too frequently, you might even have some inaccuracy for the estimators because there is noise in constructing this preference from observing the shock. So there is an whole process of how you map from like contacting the client to producing this risk preference that is ignored in the present paper. Okay, so then we want to look at now at the third question that I listed about should the robo-advisor go against the client wish, in favor of the client wishes, or go against them. And I'm presenting like a simple setup where we have two states. Let's think about economic expansions and contractions. Suppose that one is the economic expansion, two is the economic contraction. And you see that the Sharpe mean, assuming that the Sharpe rate, as we said before, the Sharpe ratio during the economic contraction regimes tends to be larger than the one under the economic expansion, precisely because the client is demanding higher compensation for holding the risky asset. And now I'm considering a trading strategy of the following type. Suppose that when the economic regime is 1, the investment is pi bar, and when instead is 2, which means the bad state of the economy, then the strategy is pi bar, but is multiplied by 1 plus delta. And this delta is modeling whether or not this is a client decision or a robo-advising decision. Suppose that delta is negative, that would correspond to the client that was left alone. So the client that is not advised, what would he do? He would reduce his exposure to the risky asset, right? Exactly because he's not aware of the fact that he might be gaining a large premium for doing that. And the other situation is that the robo-advised client who is doing the opposite. So that means that he's precisely investing more in the risky asset exactly when the economy is going in the bad state. These are the two situations. So the first situation where delta is more than 0 can be thought as the somehow robo-advising that is catering to the client wishes. Is doing exactly what the client would like. Instead, for delta larger than 0 would be the robo-advising somehow overriding or going against what the client wants. And I'm ignoring here the fact that the client might be upset and leave the robo-advisor. So I'm just thinking what is really the best that robo-advisor should do. And what we can show is a result which says that the optimal portfolio Sharpe ratio is increasing and concave around this parameter delta equal to 0. So what do these two properties mean? So first, let's focus on the increasing properties. That means that the derivative of the Sharpe ratio with respect to delta, which is basically the quantity that you are shifting up or down your exposure to the risky asset, is larger than 0. So that means that if you compare this to a buy and hold strategy, you buy and you don't do anything, then the Sharpe ratio would be lower than a buy hold strategy, than the Sharpe ratio in a buy and hold strategy if the client is left alone, so if delta is more than 0, whereas the Sharpe ratio will be higher when the robo-advising is basically shifting well towards the risky asset in the bad state. So one can show that the optimal portfolio, this is the portfolio Sharpe ratio, which means the Sharpe ratio achieved by the optimal portfolio is actually going up if you follow the robo-advisor recommendation. And then there is this concavity property, which basically says that the second derivative of the Sharpe ratio, the portfolio Sharpe ratio is negative, means that the Sharpe ratio drop when you tilt away from the risky asset. So when you shift wealth from the risky asset, will be larger than the gain that you get when you tilt towards the risky asset. So this means that basically you have a more significant drop when you left the client alone relative to the gain that you get when you instead advise the client and you shift towards the risky asset, which basically says that it's not going against the client wishes seems to be good for these two reasons. And here I'm showing a graph where we can see exactly the situation, it's two situations. The first is a client versus a buy and hold strategy. So the client would shift again away, tilt away from the risky asset. And this is the plot of the annualized rate of return of the portfolio, the optimal portfolio. You see that if you have a buy and hold strategy, you can basically get a larger, a better annualized rate of return. You see the mass of the distribution is shifting towards the right. That's the blue part of the buy and hold strategy. But now if you compare instead the client versus the robo-advisor, so the client will basically shift wealth away from the risky asset, whereas the robo-advisor will do the opposite. You see that there is an even more significant gain. So that means that basically going against the client wishes is really benefiting or is really helping the robo-advisor, is really improving the annualized rate of return of the portfolio. And it's basically what I wanted to say. And of course, I've ignored a lot of other important characteristics. That was basically an attempt of constructing a first model of quantitative robo-advising investment. Of course, there are important questions about should the recommendations depend on the monetary frequency of the client. There is evidence that short-term losses outweighs the effect of short-term gain. So this basically leads to a gradual increase in the risk aversion. And also that there is a causal relation between the frequency at which returns are evaluated and also the willingness to accept the risk. And now with the technology, this myopic loss aversion is exacerbated even more. I think one of the presentation of Alberto was mentioning, okay, what happens if you can monitor your account all the times with your phone or with an app? Then of course you are like frequently monitoring, therefore you are even more sensitive to this losses, which means that the myopic loss aversion component is emphasized even more. That means that interacting frequently is even worse than as it was before. And of course, there is also the question that you should rebalance, not all the times, which is what we are doing in this paper, but typically you want to have more threshold-based type of rebalance. So when you have large change in market price or characteristics of the client, you want to change the portfolio, otherwise you leave it as it is. There is also the question about, okay, how do you strategically determine when to interact? Because you want to avoid this behavioral bias, which inflates your risk aversion component. And you want also to strategically communicate your performance to the client. For instance, you want to show him a well-diversified, typically what robo-advisors or wealth managers do. They show the client not really the performance of the single assets where they're investing, but more about the performance of the well-diversified portfolio, so that you make the client like more, less like worried about performance. And finally, there is also the question about elicitation of risk preferences that is not, that is really, it's a difficult process. How do you actually construct these parameters? The model, we took a reduced form approach, but of course you have to really be able to consider that risk aversion coefficients might be noisy and biased. Like there is also some mixing between real risk aversion and the expectations of the client. So how do you disentangle the two? And secondly, we are assuming here that these interaction times, every time the client every time the robo-advisor decides to query the client is willing to respond immediately. But investor attentiveness is also another major concern. You might have clients that may not be willing to respond soon, or they might even be difficult to contact. Therefore, basically, you have to take into account that from the time when you contact the client to the time when you get the response, there might be some time elapsing, and you might not even get the response you want. And Alberto has a paper on that as well, about how do we look at investor attentiveness. And that's the end of the presentation.
Okay. Thank you so much, Agostino. We are wildly late, but I want to ask you one question though that comes from Lian Yang. One question was coming from Neil Stoughton, but you addressed it. Neil was asking, wouldn't it be better to dissuade investors from acting on their behavioral bias or their risk aversion changes? But I think part of your presentation was addressing it. So Lian Yang has a different question. He's asking, he's saying, great framework. He says, I know this is a partial equilibrium model, but in a closed model, who's providing the robo-advisor services? He's saying, I'm thinking about the objective function of robo-advisors, say whether the current objective function is optimal for the service provider to maximize its own profit. So I'm going to give you 1 minute. I know it's a very broad question, but basically the idea is that what would be the objective function of a robo-advisor in general equilibrium that you would envision? Or what would a robo-advisor do if they actually had the choice of objective function?
Yeah, so that's a very good question. Of course, one point is that if one can take into account a full equilibrium model, then one might also want to take into account the fact that the prices of the assets are basically being affected by the investment decision. So this will basically already be a new element that would change, at least would change the evaluation of the robo-advising function. And the other is also like that in a general equilibrium model, then you would take into account also the fact that there are clients that are willing to use robo-advising, but there might be some client that might actually decide to leave, for example, the robo-advisor, if they have observed the negative market performance following their investment recommendations, when instead they would have liked to act otherwise, like this fact that you go against the client wishes. So you would have basically entry and exit as well of the clients in the market. And this like entry and exit will also impact, of course, the price that you observe in equilibrium for the risky asset. But in general, what function, what would be the functional to use? Meaning it might be, it's a different question. Basically, a very interesting question, because here are basically saying, okay, the function is an invariance model with risk preference that is really personalized as much as possible to meet the client constraint. But in general, maybe it turns out it could be the case that a better objective function might satisfy more the client needs. But then I don't know exactly how one would be able to assess what is the best objective function, because it's like comparing different objective criterion together.
Okay, sorry, there is Alessandro also raised his hand. So Alessandro has a question. So let me very, very quickly, Alessandro, I'm muting you, or you can unmute yourself. Go ahead, you can talk now.
Hi, Agostino. I just want to suggest that there is a paper that looks at a human advisor. Yeah. It's Genaioli, Schleifer, Wisny, 2015. Yeah. And so the idea there is that human advisor initially can pander to biases to build trust. So maybe this is something you want to incorporate in your model. Maybe also human advisor, initially they are more prone to pander. And once they build trust, it's going to be easier for them to push back. So then there could be a time varying component based on length of the relationship.
I see. So this bias will basically be deliberately be introduced by the human advisor.
The human advisor, in practice, what you do is, like, if a client comes to me with a bad idea, I say, that's a great idea, and I implement it. Afterwards, when you trust me, I'm going to tell you it's a bad idea. If I tell you right away, you might just say, no, we disagree on how to invest.
Yeah, absolutely. That's a very good point. So basically, it could be incorporated in the model, the fact that you decide optimally when it's good to start not gathering to client wishes. And at the very beginning, you basically do what the client wants. Absolutely. Yeah. Definitely. That's a very good.
Thank you very much for so much activity. We are 15 minutes late, but I'm very happy that so many of you were so interested. Thank you everybody for logging in. Thank you so much, Agostino and Michael, for their great presentations. And the next event is going to be on October 16th. It's going to be Social Finance Day. So I hope to see you there. You're going to receive an invitation over the next week or two. Well, thank you very much, everybody. Have a wonderful day and have a great weekend.
Perfect. Thank you, Alberto. Thank you, everybody.